I want to start with something most people never say out loud. Most investors, not some, not a few, most investors will spend 40 years putting money into the market, and they will end up with less than they should have. Not because the market failed them, not because they picked the wrong stocks, not because they didn't work hard enough. They will end up with less because of what happened inside their own heads during the years when everything was working perfectly fine. That is an uncomfortable thing to sit with. But I need you to sit with it for a moment, because if you don't understand that truth at a bone-deep level, everything else I'm about to tell you will just sound like advice. And advice, as most of us know, is easy to hear and even easier to forget. So, let me ask you something personal. How much of your mental energy, your actual daily bandwidth, goes toward managing your investments versus managing your reaction to your investments? Because those are two very different things. And the answer to that question will tell you almost everything about whether you are building wealth or just watching numbers on a screen while quietly panicking. This is what I want to talk about today. Not hot stocks, not the next big sector, not macroeconomic theory that sounds impressive at dinner parties but does nothing for your retirement account. I want to talk about attention. I want to talk about where the serious long-term investors I have studied and admired throughout my entire career chose to put their focus, and why that one decision separated them from the overwhelming majority of people who failed to build lasting wealth. There is a pattern I have watched repeat itself across every major market cycle of the last several decades. It is almost boring in how predictable it is. Markets rise, people get comfortable. Markets pull back, people get afraid. Markets drop sharply, people make emotional decisions that cost them years of compounding growth. Markets recover, they always recover. And those same people are left standing on the sideline, having sold near the bottom, waiting for a moment of certainty that never comes, wondering why their account looks the way it does. And here is what nobody wants to say clearly. The problem was never the market. The problem was the amount of attention those investors were paying to the market. I know that sounds backward. We live in a world that rewards obsession. We celebrate the person who wakes up at 4:0 inches the morning to check pre-market futures. We give interviews to the day trader who claims to have made a fortune by staring at charts for 12 hours. We have built an entire financial media industry around the idea that more information consumed faster leads to better decisions. But the data does not support that belief, not even close. Studies of investor behavior going back decades show consistently that the more frequently an investor checks their portfolio, the worse their long-term returns tend to be. The more news they consume, the more reactive they become. And the more reactive they become, the more likely they are to do the one thing that genuinely destroys wealth. Sell when prices are low and buy when prices are high, which is the opposite of what every rational investor knows they should do. They know it. They just can't hold to it when the noise gets loud enough. So, what do the great long-term investors actually spend their time doing? They read, they think, they wait. That is not glamorous. I understand that. It does not make for exciting social media content. It does not feel productive in the way our culture has taught us to value productivity. But it is, without any question in my mind, the highest leverage activity available to any person who is trying to build serious, durable wealth over a lifetime. Let me give you a picture of what this looks like in practice. Imagine two people, call them David and Margaret. Both are in their early 40s. Both have solid incomes. Both have been investing for about 15 years. David checks his brokerage account every morning before he leaves for work. He has alerts set up on his phone for whenever any of his major holdings move more than 2% in either direction. He watches financial news during lunch. He reads investment forums at night. He is, by any reasonable measure, deeply engaged with his portfolio. Margaret checks her accounts once a month. She has a set of criteria she developed years ago for what kinds of businesses she wants to own: stable earnings, strong competitive positions, reasonable valuations. And when something meets those criteria, she buys it and largely leaves it alone. She reads widely: history, psychology, biography, annual reports. She does not watch financial television. She finds it too loud and too short-term in its thinking to be useful to her. After 15 years of this, who do you think is ahead? I think most of you already know the answer. And the reason is not that Margaret is smarter than David. She may or may not be. The reason is that Margaret has protected her decision-making from the single greatest enemy of long-term investing, the relentless temptation to do something. Markets generate noise constantly. Every single day there is a reason to be worried. There is always a geopolitical event, an earnings miss, a Fed statement, an inflation print, a recession fear. If you are paying close enough attention, you will always find a justification for action. But most of that action, most of that buying and selling driven by news cycles and short-term anxiety, is not adding value to your portfolio. It is subtracting it in transaction costs, in tax consequences, in the compounding growth you interrupted when you sold a great business because a bad month made you nervous. The bandwidth rule, and I want you to really hear this, is simply the recognition that your attention is a finite resource. You have a limited amount of mental and emotional energy to spend each day, and where you direct that energy has consequences. Every hour you spend anxiously monitoring the daily movement of your portfolio is an hour you did not spend understanding the businesses you own. It is an hour you did not spend learning about an industry that might create opportunity for you over the next decade. It is an hour you did not spend thinking clearly and slowly about your actual financial goals, your time horizon, what you are really trying to build. The great long-term investors understood this. They protected their attention the way other people protect their capital. They were ruthless about what they allowed to take up space in their minds. Not because they were incurious, but because they understood that clarity, genuine, deep, unhurried clarity, is the actual competitive advantage in investing. Not speed, not access to information, clarity. Now, I want to talk about fear, because we cannot have an honest conversation about investing without talking about fear. There was a period not so long ago, many of you lived through it, when major indices dropped roughly 30% in about 5 weeks. Think about what that feels like if you are watching your account daily. You wake up on a Monday and your retirement is worth meaningfully less than it was on Friday. You wake up on Wednesday and it is worth less than it was on Monday. Every single day the number goes down, the news is catastrophic. Smart people with confident voices are appearing on television to tell you that this time is different. This time, the damage is structural. This time, the recovery may not come. I know people who sold everything in that window. People who had been disciplined investors for decades. People who intellectually understood that markets recover, that downturns are temporary, that the appropriate response to a falling price on a good business is patience or even enthusiasm. They understood all of that. And they still sold, because when fear reaches a certain decibel level, intellect is not enough. You need something deeper than knowledge. You need a trained emotional response, a practiced calm. And that kind of calm does not come from checking your account more often. It comes from having spent years building a relationship with your own thinking, understanding your risk tolerance honestly, understanding the businesses you own deeply enough to have conviction through volatility, and choosing deliberately not to fill your mind with the kind of short-term noise that makes panic feel like wisdom. The people who held through that particular crash, the ones who did nothing or who bought more, were not braver than the people who sold. They were not smarter. They had simply built habits of attention that protected them from their own worst instincts at the worst possible moment. That is the real work of investing, not the spreadsheets, not the earnings models. The real work is building the kind of mental and emotional infrastructure that lets you behave rationally when the world is behaving irrationally around you. Think about what that kind of discipline is actually worth in dollar terms. If you had invested $10,000 in a broad index fund in January of 2009, right in the depths of genuine financial crisis, when fear was at its absolute peak, and you had simply left it alone, reinvesting dividends, not reacting, not trading, you would have watched it grow to something in the neighborhood of $80,000 or $90,000 over the following 15 years. Not because you were brilliant, not because you made clever predictions, because you did nothing. Disciplined, intentional, well-reasoned nothing. Meanwhile, the average individual investor underperforms the index by 2 to 3% annually over long periods, according to research from Dalbar and others who track this. 2 to 3% every year may not sound catastrophic, but compounded over 30 years, that gap turns into hundreds of thousands of dollars, sometimes more. And almost all of that gap is explained not by stock selection, not by asset allocation, but by behavioral errors, emotional decisions made in moments of high stress that pulled investors away from simple, patient, long-term strategies that were working perfectly fine. So, where should your attention actually go? Here is how I think about it. Spend serious time understanding what you own and why you own it. Not surface level understanding, real understanding. What does this business actually do? How does it make money? What would have to go wrong for this to be a bad investment over the next decade? If you cannot answer those questions clearly, you do not yet understand your investment well enough to hold through the inevitable periods of volatility. Conviction comes from comprehension, and comprehension takes time and quiet. Spend time reading history, not just financial history, all history. The history of how human beings have responded to crisis, to scarcity, to uncertainty. Because markets are not mechanical systems. They are human systems. They reflect human psychology, greed and fear and hope and regret playing out in real time at massive scale. The investor who understands human nature has an edge that no algorithm can replicate. Spend time thinking about your own psychology. What are your actual financial goals? What is your real-time horizon? What level of volatility can you genuinely tolerate? Not in theory, but in practice at 0 inches the morning when your account is down 20%. These are not simple questions, and most investors never ask them with real honesty. But they are the questions that determine whether your investment strategy is actually suited to you, whether you will be able to hold to it when it matters most. And then, after you have done that work, protect the bandwidth you have created. Be deliberate about how much financial media you consume. Recognize that the financial news cycle is not designed to make you a better investor. It is designed to keep your attention, which means it is designed to make you feel that something important is happening right now, that you need to respond, that inaction is dangerous. That is the opposite of what a long-term investor needs to believe. Inaction for a long-term investor, holding quality assets, is usually not dangerous. It is usually the right answer. This is not passivity. I want to be very clear about that. There is a version of do nothing that is lazy and uninformed and genuinely harmful. That is not what I am describing. I am describing the active, disciplined choice to do nothing, a choice that is harder than it sounds, that requires ongoing conviction and psychological strength. And that has to be earned through the kind of deep understanding I described a moment ago. You cannot hold calmly through a 30% drawdown if you do not understand what you own. You cannot resist the urge to sell at the bottom if you have not already done the work to know at a deep level that the business you own is fundamentally sound. The work comes first. The patience follows from the work. I have been thinking about markets and human behavior for a long time, and if I had to distill everything I have learned into a single practical principle, it would be this. Your returns over a lifetime will be determined less by the quality of your analysis and more by the quality of your attention. Where you choose to look, what you choose to ignore, how you manage the emotional experience of owning assets in a volatile world. Whether you can protect your long-term thinking from the short-term noise that is always trying to pull you away from it. The best investors I have ever studied were not the ones with the highest IQs or the most sophisticated models. They were the ones who had built, through years of practice and self-awareness, an extraordinary capacity for patient, clear, unhurried thought. They had learned to treat their own attention as a precious resource, and they guarded it accordingly. You can do the same. It starts with a simple decision. Not a dramatic one, not a complicated one, just a decision to be more deliberate about where your mind goes when it comes to your financial life. To ask before you open that app or turn on that channel whether what you are about to consume will make you a clearer thinker or a more reactive one. To recognize that the most powerful thing you can do for your long-term wealth today might be to close the laptop, take a long walk, and let your best thinking happen in the quiet. The market will be there tomorrow. The great businesses you own will still be doing what they do. The compounding that is working in your favor right now does not need your supervision. It needs your patience. And patience, real, earned, grounded patience, begins with protecting the bandwidth to think clearly. That is the whole game, and it has always been